The worst thing you can do right before retirement is to make the wrong moves when the market is shaky. And if you're planning to retire this year in 2025, you could be making some costly mistakes right now without even realizing it. If you're about to retire, maybe you've already retired, just taking a couple of critical steps can help protect yourself and secure your retirement income. In this video, I'll show you exactly what those steps are and how you can retire into a down market without risking your future. With a possible recession on the horizon, this is not the time to wing it with your retirement savings. This is the time for smart planning. Let's tell a story. Imagine with me that you're about to take off on a long haul flight flying across the country. But just before you do, the pilot comes on the intercom and he says, we haven't checked the fuel. We're not really sure about the weather that's coming up. We're going to figure out the route once we get up in the air. Would you stay on the plane? Of course you would not stay on the plane, but that's exactly what some retirees do when they enter retirement without adjusting their investments, without creating a plan for their retirement income and for managing their money with an eye on minimizing volatility. If you go ahead and retire without adjusting your investments, without planning for your income, it's like taking off in that plane without even knowing if you got enough fuel to get there, without knowing what lies ahead. You might think that you're fine until turbulence hits and suddenly you're in trouble. The first big mistake that I see people making here is they stay too heavy in their stock allocation. People often continue investing into retirement the same way they did while they were working. If I've said it once, I've said it 136,000 times here. Everything changes when you retire. I know this is a video about retiring this year, but really, if you're within 5 years of retirement, you're now close enough to your retirement that the stock market can hurt you if you don't invest appropriately. Let's go back in time to the dot-com crash. The market peaked in March of 2000. The S&P 500 hit 1552. By March of 2003, 3 years later, it was sitting at 848. It was cut almost in half. The next time the market got back to that March of 2000 level was almost 6 years later. And it wasn't too long after that the financial crisis started and the market went on yet another ride. Now, here's why this should matter to you. If you had retired in 2000 and you had too much stock exposure, your retirement could have been set back a decade plus. If you're retiring right now without adjusting for your risk level, you could be walking into the exact same trap. Now, lots of folks think, well, if it goes down, I'll just wait a year or so for it to go back up before I retire. Here's the problem with that. There's no law that says that it's going back up in a year. We don't have to go back that far in history to see that a bad market can wreck 30 plus years of saving. If you're getting close to retirement, you got to take control of your money. You can't let the market dictate your retirement. And that doesn't just mean sell everything and go to cash. That's a bad plan too. I'll talk through how to structure the portfolio in just a minute. But first, let's talk about the next big mistake. It's not minding the gap. The retirement spending gap is what I'm talking about here. Let's say that you're planning to retire. And like a lot of folks, you got Social Security coming in and you've got your retirement portfolio. And in this example, let's say the Social Security is going to be $3,000 a month and you need $7,000 a month to live on. So you've got a $4,000 a month gap. And then let's say that you've got $1.2 million put away for retirement. I'm going to make the math easy on myself. And you know the 4% rule. You can draw 4% from your portfolio. Historically, the money lasts a full 30 years in retirement. And so you think, hey, 4% of $1.2 million, $48,000 a year. That's $4,000 a month. I did it. I won retirement. I'm good to go. Here's the issue. What happens when the next dot-com crash or the next financial crisis hits and you didn't have an income plan? If you're just planning to draw from your assets and then the portfolio drops 20 or 30 or 40%, guess what you do? You go into protection mode. Like a turtle, you go into your shell. I've seen this happen. People stop living their best life. They cancel the trips. They stop going out to eat. And I understand why that happens. They're scared. If you're watching your $1.2 million go to 900,000, 800,000, and you don't know when it's going to stop and you need to draw from that money every month, you start making life decisions based on what's going on in your financial accounts. Again, you've got to control the money. You can't let the money control you. A good retirement plan allows you to control the money, not the other way around. Now, I understand being scared in that moment. Like I said, here's the thing. Planning ahead can allow you to structure your assets so that you avoid that moment in the first place. The idea here isn't that you should be brave in the face of a dropping stock market. That's foolish. The idea here is that you get yourself some protection from that type of event before it happens, so that when it happens, and I said when, because it will happen. I don't know if it's happening right now, but it will happen. Markets go up, they go down. When it happens, You've insulated your life from the market having control over you. This is exactly why I love pensions. You hear me talk about it on the channel all the time, because most folks who retire with a pension and Social Security have most, if not all, of their base retirement spending needs covered. But if you don't have a pension, you've got to assess your retirement income gap, and you've got to create a plan for where you're going to draw the income. The final mistake that I see is people panicking. I kind of talked about it a minute ago, but in this case, the panicking I'm talking about manifests itself in two different forms. The first one is overcorrecting. That's coming into retirement, selling most or all of your stock market assets, which feels good, but is often the wrong decision. And I understand the thinking here. It's the opposite of what we just talked about. I won't expose my money to that fluctuation, so it can't hurt me. The issue is that playing it too safe allows inflation to eat your lunch for you. I'll show you a graphic here I've shown before. This is the real rate of return on a CD over the last 20 years. Real rate of return, meaning what did you earn minus taxes, minus inflation. Historically speaking, cash loses money in real terms. You can see it right here, while your account value doesn't actually drop. The value of the money, what you can do with it, is eaten away by taxes and rising cost of living. So while avoiding the market might provide you some comfort in the short term, the cost of that comfort is slowly robbing you of your best retirement over the next 30 years. The second type of panicking that I see is experiencing the drop and then selling at the worst time. We see this in every downturn. People panic and they sell because they're scared, and I get it, but then they miss the recovery. Timing the market is not the answer. Here's another graphic to show you. This shows the returns of the S&P 500 over an almost 20-year period. If you missed just the 10 best days of that whole 20-year period, invested the rest of the time, you go from a return of over 7% per year, quadrupling your money over 20 years, to less than half that. And if you missed the best 30 days of the market, it actually meant that you lost money. Now, nobody would be so unlucky as to miss the best 30 days of a 20-year period, but this graph shows you that one of the worst things to do in a rough market is to let the emotion make the decisions for you. Now, normally this is the part of the video where I tell you why it matters, why whatever I just explained to you should be meaningful to you, but I don't think we need to do that today. I think it's pretty clear. If you're still watching, you know exactly what's at stake here. So we're going to get right to the part of what you can do to protect yourself. As you no doubt know, the risk of recession is on the rise, and as a result, the market is falling. Here are the mission critical steps that you need to take right now if you're planning to retire this year, or truly if you're just planning to retire in the next couple of years. I regularly talk about the 5 plans that every retirement plan needs to account for. In this case, we're going to focus on 2 of them. We're going to focus on the investment plan and the income plan, because those are the 2 that are most at risk when we're talking about retiring into a down market or a choppy market. First off, as far as your investment plan goes, step number 1, assess your risk. How much stock exposure do you have right now? And then stress test the portfolio. What's the historical worst thing that's happened here? What happened to a portfolio like that if another .com happens, if a 2008 happens? What happens to your account value as you're currently invested? And then step number 2, are you okay with that result? And what I mean here is, first and foremost, if that worst case scenario happens, does it impact your retirement? It may not. You might have tons of income coming in, pensions, Social Security, well in excess of what you need to live. And then you have some other assets. And so the stock market money you have might be okay to be at risk. But for most people, if you're sitting at 70 or 80% stock invested going into retirement, and we hit a 30 or 40% market downturn, it changes their retirement math. And either they can't retire or they have to really scale back what their retirement looks like. The second part of that question, if it doesn't actually change the retirement for you, is, are you comfortable with that amount of risk? Even if you can withstand it, do you want to withstand a drop like that? If the answer to either of those questions is no, you got to de-risk the portfolio. Now, we do that with a 3-bucket retirement strategy. If you've seen my videos, you know what that is. I talk about it a fair amount of the time. If you haven't, I'll link a video in a minute for a deep dive on bucket planning, but I'll give you the quick 30-second, 1-minute overview right now of what I mean. Think of your money like a well-planned kitchen. Imagine walking into your kitchen and opening up the fridge. It's almost dinner time, only to realize it's empty because you stocked everything in your freezer and you have nothing to eat for dinner tonight. That's exactly what happens when retirees have too much money in stocks and not enough money set aside for short-term needs. You can't keep everything in the freezer because you need some fresh, ready-to-eat food for right now, for today. A well-planned retirement has all of these types of food, not just a lot of one single thing. And so how do you turn your portfolio into that well-planned kitchen? Well, first off, bucket number one, this is where you'll keep some short-term cash, but it's not just emergency fund money anymore. Now that you're retired, it's money you'll need for day-to-day income plus your emergency fund money. As far as investments go here, think things like money markets, CDs, maybe short-term bonds, and you want to think in terms of 2 to 5 years of whatever your gap is, that retirement gap. You need 2 to 5 years worth of money readily available and things that aren't going to fluctuate. Moving on to bucket two, it's a place for additional conservative investments to maybe low to moderate risk level investments. A bond fund or a bond ladder, a CD ladder, maybe dividend paying stocks if you're a little bit more aggressive of an investor. These types of assets will generate slower growth, but they'll also generate income to refill bucket number one as you need. And it provides a buffer to your growth money, which lives in bucket number three. Bucket three is your growth money. These are your stock market assets. Now, the advantage of having those first two buckets is that you don't have to rely on bucket three money for day-to-day income. You've protected your income needs for maybe the next 10 plus years, which means you can allow that money to fluctuate and grow over the long run, because for most people, retirement's a 30 plus year journey. The key takeaway here is this. This structure allows you to ride out the market dips without selling at a time when markets are depressed because of the buffer of the first two buckets. You can sell assets from bucket three at a time that you choose rather than a time of need. You're able to control the money, not let the money control you. If you're planning to retire in 2025, you got to get this right. One wrong move could set you back a decade. Don't leave it to chance. If you want help building a plan that works for you so that you don't have to worry about what happens next in the market, click the link below to schedule a no-cost call, and we'll talk through it together. Now let's get to the other plan I just talked about. You need to get real clear on your income plan. Exactly what is that income gap, and how are you going to take income from the portfolio to fill it? So let's go back to the example I gave earlier. You're retiring with Social Security of $3,000 a month. You need $7,000 a month total. So you got to find $4,000 a month from somewhere, rather than just keeping it all in the pool of assets that you draw from. In this case, you got a couple of different options to create that income. You could build out a conservative CD or bond ladder that you're going to consume over a period of time to meet the income needs. Now, the advantage here is it'll take a smaller portion of the portfolio. The disadvantage is it's going to require you to spend those assets down. It's probably less than ideal in this case because you have a pretty large income gap relative to the size of your overall portfolio. So there's some pluses and minuses to doing it this way. A second option would be using a larger portion of the portfolio and then just look to draw income from it rather than to consume it to draw down the principal. Again, you could look to bonds, real estate investment trusts, dividend paying stocks if you can stand some of the volatility from it, but put enough money there to create as much of the $4,000 a month in income as you'd need. This might take a pretty good chunk of the portfolio, but it potentially preserve the value of the investments by structuring a large part of the portfolio into income creation vehicles. Now, the third option that you'd have here would be to backfill that income gap by using an income annuity to guarantee yourself lifetime income. I often equate this to creating a pension of your own. Is very similar. Now, there are lots of variables here, and that's not the point of this video, but I've got other videos on the channel about it. If you want to learn more, go seek them out after this one's done. The advantage here is that annuity payout rates are high right now because interest rates are still pretty decent. So you can likely take a smaller portion of your portfolio to create that regular retirement paycheck that you need for less money than you could have if you'd have done this, say, 5 years ago. In that way, this is a good time to retire because retirement income is cheap, at least historically speaking, regardless of the route you take. Remember, at this stage, your goal isn't maximizing the growth of the portfolio anymore. It's not to make the pie as big as possible. It's to create sustainable retirement income that will provide you the retirement paychecks that you need to live the retirement you've been working towards for all of these years without letting the stock market rob you. I should clip that last part there and just play it on a loop over and over again, because that's what you need to consider when you're putting together the retirement portfolio. I've said it a few times here today, but I'm going to say it again. Retirement should be about freedom, not about fear, but it can only be that way if you take control of it before the market takes control of you. If you want more clarity on how to do that for yourself, here's that deep dive 3-bucket retirement plan video that I talked about a minute ago. I'll see you over there.